For some physicians, buying a stake in an existing medical practice starts their private practice career. For others, it's a move away from full ownership responsibilities as they inch closer to retirement. Whatever your situation, examine your buy-in agreement thoroughly to make sure it suits your purposes. Here are some financial considerations you should make. The valuation method used. How did the practice determine its value? They might have focused on their ability to generate income or profit, the sales prices of similar practices in the market, or the value of their receivables, cash, equipment, and tangible and intangible assets. Each method will yield very different final figures. The payment terms. Your total buy-in cost, payment schedule, and any other financing arrangement should be clearly outlined in your agreement. Pay specific attention to any requirements for upfront payments or installments. Ownership percentage. Is ownership equally distributed among partners, or are you getting a smaller share? And does your percentage correlate to your buy-in cost when you consider the practice's value? You should also know how ownership percentages impacts profit sharing and decision-making authority. The business structure. The practice's entity type directly impacts your tax scenario. If it's a C Corp, for example, you'll get a Form W-2 for your wages. If it's an S Corp, however, you'll also receive a Schedule K-1 showing your share of practice income and distributions. In that case, you'll need both of these documents to complete your personal tax return. How income and expenses are allocated. Some practices distribute workload, compensation, and expenses evenly among partners. Others pay you for the work you perform and collect revenues for, and then allocate expenses based on use. Determining which is better depends on your share of ownership, work hours, and other factors. For example, let's say you've got a smaller slice of the practice revenue than other partners. But indirect expenses like rent and other overhead are allocated evenly across the board. They may not be entirely fair to you, and something you'll want to address before signing. Buy-sell provisions. What are the conditions if you choose to sell your share of the practice someday? Also find out how the value of your share will be determined upon your exit. There's plenty to look at on the operational and legal side as well, like non-compete clauses, operational control, insurance, and liability. So in addition to consulting with your healthcare CPA, enlist the help of a lawyer when structuring or reviewing a buy-in agreement.